What's up guys, and welcome back to Wall Street Millennial. On this channel, we go for everything related to stocks and investing. Today we're continuing our coverage of the market crash, which has gripped tech stocks since the beginning of this year, and trying to figure out how much downside could still be left. When you're having trouble making sense of the market, it can sometimes be useful to listen to market veterans who have been in the business for decades. One of the most well-respected such investors is Jeremy Grantham, the co-founder and chief investment strategist of GMO, an investment firm with over $100 billion of assets under management. Grantham is 83 years old and has made a name for himself by correctly predicting numerous market bubbles. He predicted the Japanese real estate and stock market bubble of 1989, the dot-com bubble of 2000, and the real estate bubble in 2008, which led to the global financial crisis. While each of these bubbles were obvious in hindsight, Grantham was one of the few investors who saw them coming beforehand and avoided catastrophic losses. In his view, we are currently at the peak of a super bubble, which is just now starting to burst.
The trend line, being slightly generous, is 2,500. And most of the great bubbles, the super bubbles, go below trend and stay there for quite a while. In the Greenspan era, that tendency stopped. In 2000, yes, the NASDAQ came down 82%, which was fairly brutal. Amazon came down 92%. But the Federal Reserve raced to the rescue so loudly and strongly that they stopped the decline in the S&P at trend line. It only declined 50%. 50% is a hell of a big decline, but it was only enough to get it back then to trend. This time trend is at most 2,500. And I would expect, even if the Federal Reserve tries to do the same, it will be hard to prevent the market from declining to that level.
Currently, the S&P 500 index is at 4,356. Grantham thinks that it will crash down to 2,500, which implies a further 43% downside. And he thinks that technology stocks will do even worse. Going down to $2,500 would wipe out 3 years of gains and take us back to levels not seen since the beginning of 2019. This is quite a draconian view of the markets, but it's important to note that this is not a complete consensus. Ark Invest's Cathie Wood says that disruptive technology stocks are in deep value territory, and now is a golden buying opportunity. Jeremy Grantham and Cathie Wood are predicting the exact opposite scenarios for the market. Obviously, they can't both be right. In this video, we'll take a deep dive into their competing predictions to see which of them makes more sense. Quick pause from our sponsors over at Masterworks.io. Given the high uncertainty around the stock market and inflationary fears, now more than ever, it's important to diversify into alternative asset classes. In my search for uncorrelated investments with strong risk-return features, I discovered an asset class that almost no one is talking about: art. Art has outperformed the S&P 500 by 164% from 1995 to 2021, while showing low correlation to any major asset class. On top of that, it is proven to outperform during times of inflation. In fact, when inflation was equal to or higher than 3%, like now, contemporary art's real return was 23.2%. Want to know the S&P 500's return during that same period? 3.2%. And thanks to Masterworks, investors like me and you can gain access to this market. Masterworks buys multi-million-dollar artworks by famous artists like Picasso, Warhol, and Basquiat. Here's how they do it. Masterworks leverages data to understand artist markets and trends within the asset class. After identifying attractive opportunities in the market, Masterworks acquires multi-million-dollar paintings with their own capital. Then, they file the painting as a public offering with the SEC, which allows them to securitize the paintings. Getting started with Masterworks is super easy. You visit their website, create an account, and browse their artwork. I personally used Masterworks to invest in Homie Assist by Pablo Picasso. So use the link in the description to gain priority access and invest in Picasso today. And now back to the video. A few days ago, Jeremy Grantham published a long and detailed report explaining why the stock market is currently in a super bubble. I put a link in the description below, and I recommend you read the whole thing if you have time. Grantham thinks that today's stock market looks extremely similar to 3 previous super bubbles over the past century: the market crash during the Great Depression and the Japanese stock market bubble of 1989. For all 3 of these bubbles, the rate of price increase accelerated in the last couple years before the crash. If you draw a linear trend line through each of the charts, you can see that they went well above the trend in the last couple years. As the bubble inflates, people get more and more excited, pushing the prices up even further. But eventually, the valuations become absurd, and it reaches a breaking point. In Grantham's view, another common characteristic of bubbles is that they don't pop evenly. The bubble stocks that led the market on the way up are most overvalued, and are thus the first to collapse. This can be seen clearly with Cathie Wood's Ark Innovation ETF. At the start of the pandemic, her disruptive technology stocks massively outperformed the S&P 500. They peaked in February of 2021, almost 1 year ago. Since then, they've been massive underperformers and have given back almost all of their gains. A lot of these companies are losing money and have extremely high price-to-sales valuations. When a company has no earnings, it has no valuation to support, so they are the first stocks investors dump when they get scared. The mega-cap tech companies like Apple and Google are highly profitable, so investors are more comfortable holding onto them. These blue-chip stocks will be the last man standing, but Grantham thinks that even these stocks will eventually crash and bring the market indices down with them. Another telltale sign of a market bubble is crazy investor behavior, which is a little bit more difficult to quantify. In recent years, trading apps like Robinhood have gamified the stock market and brought in tens of millions of new investors. For investors who first started buying stocks at the pandemic lows, they've never experienced a bear market and think that stocks only go up. Things have gotten even crazier with the rise of cryptocurrencies. Dogecoin was started as a joke, but achieved a market cap of almost $90 billion at the peak. And Melania Trump is selling NFTs for hundreds of thousands of dollars each. Grantham developed a model to predict the fair price-to-earnings ratio for the S&P 500. He uses 3 variables as inputs: the average return on equity of companies, volatility in inflation, and volatility in GDP growth. A higher return on equity should increase PE ratios because it means companies are more profitable and it should be easier for them to grow their earnings. Higher volatility in inflation or GDP should decrease PE ratios, as investors hate uncertainty and thus demand a higher risk premium. In Grantham's view, the Fed created the current bubble by printing trillions of new dollars. All of this new money is causing inflation to rise, which will ultimately bring the downfall of the bubble. Importantly, high and volatile inflation is a major crux for Grantham's market crash predictions. And this brings us to the other side of the debate, where we have Ark Invest founder Cathie Wood. She thinks that inflation fears are overblown, and disruptive technology stocks are now in deep value territory. A few weeks ago, she published an article explaining why this is the case. I also put a link to this in the description below. While her stocks have been hit the hardest in the recent market crash, she thinks this also sets them up to massively outperform when the market rebounds. She made a table showing the performance of some of her top holdings: Zoom, DocuSign, and Teladoc. These stocks were down between 50 and 70% from their all-time highs. In fact, they're down even more now. But she points out that in the same time period, their revenues have increased dramatically despite tough year-over-year comparisons. While these stocks may have been overvalued at the peak, they're at least less overvalued today. She says the stock market has become dominated by quantitative hedge funds who use algorithms to buy and short stocks on a minutely basis. These quants make up 70% of market volumes. Whenever inflation or interest rates increase, these algorithms are trained to automatically start shorting companies that are losing money or have high price-to-sales multiples. The quants have no idea what are the future growth prospects of these companies or what disruptive technologies they have developed. The talking heads in the financial media cover the negative momentum non-stop, as market crashes always make for good headlines. This adds to the aura of fear and brings even more selling pressure. Wood thinks that the narrative around inflation has gotten way ahead of itself. As artificial intelligence and other technological innovations advance, the real cost of producing goods and services will decrease. This will offset at least some of the new money that the Fed has printed. During the pandemic, the savings rate increased dramatically, driven by stimulus money and people being unable to go outside to spend their cash. This has built up huge pent-up demand, causing consumer spending to skyrocket once the economy reopened. At the same time, COVID-related supply chain issues reduced supply for many goods, causing prices to rise. As these transitory issues work their way out of the economy, inflation will moderate throughout 2022, and the Fed won't be forced to raise rates as much as feared. This will allow the entire stock market, and especially the disruptive innovation stocks, to rebound. Both Jeremy Grantham and Cathie Wood make good points. If you read either of their reports individually, you'd probably walk away agreeing with them. But they come to the exact opposite conclusions. That's why trying to predict market crashes and bottoms is so difficult. Jack Bogle invented the index fund. He says that one of the main reasons most professional investors underperform the indices is because they try and fail to time market corrections. At the end of the day, nobody knows for sure where the market will be 1, 2, or even 6 months from now. But as long as the American economy continues to chug along as it has for the past 200 years, the stock market will almost certainly be higher 3 to 5 years from today. With that being said, the valuation gap between growth and value stocks is near record highs. To the extent that we're in a stock market bubble, it's likely to be in the growth stocks, not the value stocks. The S&P 500 Value Index has a forward price-to-earnings ratio of 17 times, which is only slightly higher than historical averages. If you think tech stocks are in a bubble, it's probably better to rotate to value stocks instead of converting to cash. This way, you can avoid any potential bubble in technology stocks, while at the same time continuing to participate in the normal gains of the stock market. Alright guys, that wraps it up for this video. What do you think about the current market crash? Who was right, Jeremy Grantham or Cathie Wood? Or is the reality somewhere in between? Let us know in the comments section below. As always, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.